Everybody, welcome to the live stream. I'm John Lorenzini, aka JLo, VP of Marketing Science here at LiftLab. And this is our seventh Curve Your Enthusiasm in the series, with this one being the pressure to perform, where innovative brands needs to invest in their marketing spend portfolio with Matt Skai. Here's joining us today. We're going to go through a little bit about Matt's background, how brands need to treat their marketing mix like an investment strategy, some change management, as well as metrics and KPIs, like what people should start looking at or stop looking at. A quick rehash. So Curve Your Enthusiasm is bringing everyone from the classroom to the boardroom to the practitioner's room, and being able to take that jargon-free analytics information and provide you hopefully meaningful insights or actionable insights that you could take home with yourself. So now let's jump in and meet our speakers. First up, we have the co-founder of LiftLab, my boss, and the former co-founder of DataSong, which successfully exited to market share, John Wallace. Hey, John.
Hi, everybody. Glad to have you here this week. And it's really fun to do number 7. Let's go. Let's introduce our guest. I love it.
And then next up, we got Matt Skai, otherwise known internally here as L Cat Matt. And Matt is the vice president with L Catterton Portfolio Operations. He was the former CMO of several customer brands, and he drives strategic marketing decisions, guides portfolio companies, and advises executives on maximizing their growth and profitability. Hey, Matt.
Hey, how's it going, guys?
And for everybody in the chat here, we'll have a Q&A session at the end, but please pepper in some questions. If it's relevant to the conversation, we'll work it in dynamically. You all were here in real time, so I think that your ability to interact with Matt, who we're very lucky to have here today, is a benefit of you being here on a beautiful day. So please jump in there. If we want to jump into the topics here, maybe we can start a little bit at how, Matt, you ended up here with John. So maybe starting at the beginning, and then we can get into the other topics.
Sure. Yeah, I think we got introduced to LiftLab through a company in our portfolio probably a couple of years back at this point. And I think at the moment we had been, I think as most companies are, kind of going through the motion of trying to figure out what does best in class attribution look like. And, ultimately where we netted out was it doesn't exist. There is no such thing as best in class attribution. There's just slightly better than other types of attribution. And when we were trying to figure out what in the world is going to be the best of, what is a very difficult, solution to solve, and somebody in the portfolio said, "Hey, have you ever met the guys at LiftLab?" I was like, "No." And they introduced me to John, and now we've been working with John for a couple of years on getting them into companies in our portfolio, and just working with him as the product has evolved into understanding how to really leverage incrementality testing, media mix modeling, all in one platform, which has been great. So it's been a fun journey over the last couple of years.
Cool. And I feel like with your journey before LiftLab, you were working on a bunch of customer-facing, consumer-facing products. You probably picked up a lot of different strategies for investments depending on the marketplace or which business you're selling. Could you tell us a little bit about how you treat your marketing spend, your media investment, as a financial instrument or a investment portfolio?
It's interesting. I don't think much has changed as I've gone from being an operator inside a brand to being on the private equity side. I think the perspective, for me at least, has been consistent in that your marketing is not a cost center. Your marketing is a revenue driver. And if you don't think about your marketing as a revenue driver, then you're probably making some really bad decisions with your marketing. I think that's even true of brand. A lot of times people go, "Oh, well, maybe that's true of your performance marketing, but your brand awareness needs to be making long-term investments and not necessarily correlated with short-term revenue, and needs to be driving, things that'll pay back in 6 months from now or 18 months from now or 36 months from now." And while personally I believe there's some validity to that, there's also the reality of like, well, if people aren't responding to it in the short term, what makes you think they're going to respond to it in the long term? So kind of consistent throughout my career is kind of how I viewed marketing, and now have the opportunity to not just take that perspective at one company at a time, but, kind of with the L Catterton portfolio, which is over 100 companies worldwide, can, work to deploy that type of mindset across a larger, scale of companies.
So I like, well, I want to double click on the word portfolio, right? Because L Catterton has a portfolio of startups that most of us don't, but we all have portfolios probably in our investment accounts, retirement accounts around holding a whole bunch of equities and things like that. Do you think brands have that kind of discipline to look at how they're spending and adjust it on a, kind of period on period basis? Do they have what would be the opposite of a portfolio? You just come in and spend all of your budget on Meta? Or like all, it'd be like only buying Tesla stock, right? Like you just like all chips on Tesla. How many channels do you see folks running on average? And, what are the step functions where they add more marketing channels?
Yeah, I would say it's pretty broad. I would say it really depends on your evolution as a business and kind of where you're at in terms of business stage. I would say that in the early days, especially if you're going after something relatively niche, in a market, you're probably going to be heavily focused on search early on, right? Just trying to capture some of the niche, inbound search that's going on for that category, trying to redirect it to your website instead. Because something like paid social is going to be extremely expensive because you need to do a ton of education on whatever that niche service is. And you're not going to get the ROI in the early days. Versus, let's say you have something that's relatively commoditized. Search actually might be very expensive to start there because everyone's going to be competing for those eyeballs. And maybe you'll actually have better luck getting through in social through a unique story, unique creative, and unique messaging. And you don't need to do education on the categories. You can drive consumers through that channel. So those are typically the two starting points that we see for a startup to take. And then as they get to a $10 million company, $100 million company, we even have some $1 billion companies in our portfolio now. And I've worked at, companies that do hundreds of millions of dollars in revenue in the past. The evolution typically evolves from whatever that starting point was. So as you kind of hit a saturation point on search as a niche business, it's impossible to continue to grow your scale until you start building some brand awareness in that category. So inevitably, you need to start investing in social. You need to start doing influencer. You might need to start doing out of home and TV, really around category education. Versus somebody that is in a commoditized space as they grow and as they build this really great base on social and kind of other channels that allow them to differentiate their messaging, will hopefully see more search related to their brand and will allow them to branch into more bottom of funnel oriented channels like search as they grow. So long-winded answer, but ultimately, I would say as you start approaching, the $10 million budget mark, in terms of marketing, I'd like to see at least 3, 4, 5 different channels in your mix. And as you start getting to the $25, $30, $40 million mark, you're probably looking at 5+ channels at minimum.
Just riffing on what you said about, creating the category versus capturing the demand, when you're doing non-branded search, capturing niche versus educating. Do you have any opinion in terms of, and please shut me down because I'm riffing here, on allocating spend towards the growing the demand of a category versus growing against your brand? Because I think a conversation we have is upper and lower funnel, but then within upper, it's category demand or brand demand. So do you have any insight into that?
Great question. It's a complex one because a big factor that goes into that is how competitive is your category and how much education needs to be driven in that category. And then the second component is how's your cash position as a business, right? If you can afford to take the risk to go out and say, hey, we're going to go put $4 million into marketing strictly behind category education and trying to expand our, target demographic for this category, that's great, but you have to know that that's high risk, high reward, right? You might be helping build the category and your competitor might be trying to swoop in on search and trying to steal that traffic. Maybe your messaging doesn't land and you've put $4 million into market that maybe didn't generate that long-term return that you want to see on kind of that brand level investment, category level investment. I think it's much different if you're saying, hey, I have a $200 million marketing budget for the year, and I'm going to go put $5 million on doing some really cool bespoke category building activities
Yeah,
versus I have a $6 million marketing budget for the year. Let me go put 5 million of that on, those. So I'd say it really depends on stage of business, how much capital you've raised, your cash position, and your risk tolerance as a company.
Has anything in your past surprised you in that, where someone was investing in the category building and you're like, I don't know about that, and then it just turned out to work really well? You don't have to name the specific brand, but has there ever been this successful criteria where that works out really well in that risk reward?
Yeah, I mean, I think the right way to do it and where I've seen it be really successful is I don't think there's any company in the world that just goes and strictly builds category, right? You're building that category underneath the guise of your brand. So to be able to, let's say there's somebody who's never gone after the angle of saying, hey, you can have I'm just making something up here, a low cost, but high quality massage. And they're trying to build out this like low cost subscription model for massage as a service. And that's the business that they're going after, which, by the way, if anyone wants to create that, sounds great. And I highly suggest you guys start that business. You might go and, people might think, oh, to get a good quality massage, I need to spend at least $80 on that massage. I can't believe that I can get the quality at a lower price point. If you're going to go out and start building a market for subscription massages at a lower price point, like you're still going to do that underneath the guise of your company and selling the value propositions of your company. But you are aware that that's not a market that exists today and that it might take a significant amount of time before the, lagged impact of your investment in that brand marketing catches up to your revenue. Kind of counterpart to what I was saying at the very beginning, where I was saying I still like to see some results from revenue. So it's like, even as you're building that brand, I'd like to see signals and signs that there's responsiveness to those new demographics and markets. But it's a tolerance that you're going to have to wait to say, hey, maybe we don't, hit a 2x return on our marketing spend in the first month. Maybe we're okay with only a half return on our marketing spend in the first month. But we really do believe that we're building awareness and we're tracking things like, brand awareness and consideration, all those other things that make us feel confident that we'll be able to continue to grow revenue in the future months.
That's really interesting. And I do think like de-risking risk is what measurement sort of does. And those upper funnel metrics that you mentioned, brand awareness, consideration, long-term impact, are those things that you actively monitor? Are those parts of your equation? When I think private equity investment finance, I do think a little bit more dollars in, dollars out, but I'm sure you have a little bit of art and science of mixing those two worlds together. Could you talk about that a little bit? Maybe not LCAT specific, just in your history.
Yeah, look, I would say that I think it's regardless of whether it's PE owned, not PE owned, it's a startup, it's a Fortune 500. I think the principles should remain the same, which is there's no such thing as too much data, but there is this thing of what are the right data points that we should be looking at. So if you are at a point as a business where you are, let's say, spending, I don't know, 30% of your revenue back in marketing spend, you're not profitable, and you are heavily invested in television. Yeah, maybe it's great that your brand awareness is super high, but you're obviously not capturing that demand in a way that is driving profitability for your business. And therefore, brand awareness might not be the right metric for that moment in time. On the flip side, maybe you are super, super cautious about how you're spending your budget, and you're only spending 4% of your revenue back on marketing spend, which, by the way, I hate that as an arbitrary guard, but you're spending 4% of your revenue on marketing spend. You're only doing paid search and a little bit of paid social, and you've hit a wall. And every time you try to spend an incremental 1%, it just goes straight to the CAC metric and isn't driving any incrementality. And it's because you didn't make the investments in building your brand awareness. So maybe metric for that moment in time. Mm-hmm. So I think it's all about just evaluating where you're at as a business, where are your blockers, and what are the KPIs you need to achieve to overcome those blockers.
While we're at metrics, like, are there any, you sit in a lot of meetings, right, amongst marketers and CFOs. Are there any metrics that you have, watched people kind of cling to a little bit too much?
Yeah, it's a good question. It's actually an interview question that I like to ask, which is, what's a metric that your CEO loves that you wish they would stop looking at? And it's a question that I love to ask because it really allows me to understand, do you understand the difference between a metric and a useful metric? And
Right.
sometimes it's even the metrics that we think are useful metrics tend to not be very useful. One example that I always like to give on that is just customer acquisition costs. I
Mhm.
hate that as a metric
Yeah.
because you could have two
Preach to
companies.
the choir.
Yeah. You can have two companies both doing $100 million in revenue, both spending $20 million a year in marketing.
Yeah.
Both are dog food companies, both operating in the US, both selling dry dog food, both with the same exact CAC. And one is a very successful business, and one I would have concerns about because one has figured out how to go from 20 million to 40 million and has proven incrementality to their marketing spend. Maybe the other one just got lucky with a couple of organic influencers that really helped drive up short-term revenue, but hasn't figured out a scalable incremental marketing program and therefore has no way to double their marketing budget in a profitable way. So customer acquisition costs and all the other metrics look identical for business A and business B. One I'm very excited about, one I'm not excited about at all. So
I mean, that's not a marketing strategy. We're going to just next quarter get some more organic influencers and everything's going to work.
super easy to do. Yeah. So that's why I typically don't like looking at things like benchmarks or, those kind of blended metrics. They're helpful for kind of moments in time snapshot and saying, hey, did our CAC get better or worse? Sure. But to try to compare yourself against another company or just to say in general, is CAC A good or CAC A bad? It's kind of hard to say without really understanding what are the different levers and kind of subcomponents to making that CAC.
I feel like that's a topic that could get its own, episode of
Yeah.
the mistakes that we've seen people make with benchmarks, right? Chasing what the people down the street are doing, but you said it earlier here, right? It just depends on what stage you're in. In this case, it depends on the shape of your media plan. If you're like, well, that those two hypothetical companies with 100 million in revenue and 20 million in spend, I mean, they could have very different and having one try to chase the other or vice versa. Like, to me, I've never kind of found, I mean, maybe you use it if you don't have good measurement, you use it as a way to do some big step function, improvements. You use it for social proof or something like that. But why would I want my competitor's media plan? That doesn't sound very attractive at all. Right?
Look, or even if you did go with their media plan, right? Like how you execute the creative strategy is, 10 times more important than, your media mix, right? Like I always say, like, if you can optimize your media mix as much as you want, if your creative and your storytelling and your messaging isn't resonating with a consumer, it doesn't matter where you put your ads because it's not working at that point. So like, I think like for companies to really get to a scalable place, it's like figure out the right creative and messaging, figure out the right website. Then that's when something like LiftLab, right, or any other sort of measurement capability becomes exponentially more valuable because now you're starting to optimize what's your biggest remaining lever versus when people hyper focus on optimizing media mix before they start actually putting good creative out in market or having a website that's converting. It's like you're optimizing something that's suboptimal, and therefore you might not be optimal for in the long term.
I mean, we make that assumption kind of going in, like we tell brands, we're assuming you're putting the best play on the field, right?
Yeah.
You've got your best people writing copy and that you've got your best creative assets and that the job here now is to benchmark that. When I say benchmark, get your own personal benchmark, right? To measure it objectively. And then decide how much of it do you need? Do you need more of it or do you need less of it? And the answer that you get should be different than your competitor, right? Because they just don't have the same playbook, the same brand awareness, the same, there's just no two companies that are ever alike. And so they're going to have a different mix.
It sounds like, Matt, like summarizing what you were saying before of how competitive is the market for the category it's in, and then where you are in your growth cycle is really the contextualization of what metrics you look at, which metrics matter, and what's an acceptable number. So if you jump right to the KPI without that context, it becomes less informative because you have to ask those foundational questions first. Is that correct? Do you agree?
Totally. It's something that joke about all the time, but I get asked all the time still. I get people who reach out to me and be like, hey, curious what your perspective on, what a good conversion rate is for a website in this category. And I'm like, I can't even try to answer that because there's probably 10 or 20 other factors that go into what bucket would I put them in to say, is that good or bad? And even then, there's probably so many additional factors that you can't even conceptualize or measure that would also influence what that, right conversion rate would be. So I think, John, to your point of like your own personal benchmark, right, is more valuable than your benchmark compared to somebody else, because often those benchmarks really glaze over the nuance that exists between individual businesses.
This is a little bit of a curveball here. What is the non-quantifiable zhuzh that would be when you're looking at a brand that you look for, you don't know how to measure, but you definitely know it when you see it? What would be something that kind of comes across your plate where you're like, oh, they got it?
Well, I think almost everything is quantifiable. It's just how much time and effort do you want to spend to quantify it. But I think when it comes to that, the hardest thing to quantify and the most important thing is just the team at the company, right? Like there's times where I meet a marketing team and I'm like, wow, these folks just get it, right? Like they are, I don't even need to explain the concept of incrementality. They are doing, widespread creative testing with different messages against different segments. And they're, pulling in insights from AI to see what's working best in different images. And they're optimizing their whole machine in real time. And they're doing surveys with their customers to be able to understand, what they like and what they don't like about the product, and leaning into the value propositions that are most valuable. And it's just like, wow, okay, these, even if they don't have it right today, they have the team to get it right. Versus sometimes you look at a company and from the outside, you're like, wow, their creative's beautiful. They're, they're really scaled up. They're really successful. Everything about this business sounds great. And, you meet the team and, maybe they're good marketers, but they don't have that X factor that makes you feel like they're capable to take that to that next level. And then that's one that you go, okay, well, that's where we need to think about where the resources we have to bring in to, help that company be successful long-term, because not every single person is going to be the, all-star marketer, because if everyone was the same type of marketer, then no one would be the all-star marketer, because no one has any differentiation in terms of capabilities at that point. So I'd say that's probably the hardest thing to quantify, and probably one of the biggest determinant factors on success. And then I'd say the other one, which unfortunately is heavily out of the control of the company, it's just macroeconomic wins, right? Going back to, let's say, like the dog food category, everybody, and their mom was getting a dog during COVID. And, dog food category was, super hot. I don't have specific data on how the dog food category is going now, but I'd imagine like it's still probably doing pretty good because you have all those people with dogs now that are continuing to get dog food. But like, I don't know, at some point, do you see a slowdown in pet ownership as people kind of get over that in post-COVID? And maybe in 5 to 10 years from now, do you start to see that category slow down? It's like, well, unless you're like the world's largest dog food company and you have some amazing campaign, like a De Beers type campaign that convinces people to buy diamonds, that convinces people to buy dogs again, you're probably not going to be able to, really change that category in a meaningful way.
Yep. And it's funny, you mentioned that like the snapshot in time and the team is kind of the projection of the future. And John always says internally, the horse we rode in on is not the same horse we ride out on. And I think that, willingness to change prevents that stagnation that might occur. And like brain drain of someone who made all that beautiful creative leaves. One thing you mentioned in your response about the process with the AI tools and whatnot, and we actually talked about on our pre-call ChatGPT being a large portion of your workflow. Is there any advice, watch outs, learnings from incorporating AI that you've seen either through your personal experience or through brand's experience?
Good question. I think it's going to change a little bit in the next couple of years. So I can answer for like how I see it today and how I could potentially see it in a couple of years. I think today AI is a great ideation partner, right? you could upload all of your reviews of all of your products into ChatGPT and say, hey, use natural language processing to help me figure out what customers do and don't like about our products. What are the selling propositions that are strongest? It'll then do that analysis and give you a really nice readout on what's good and what's not so good about your products. And then you can say, hey, we're working on a, Halloween campaign, and we want to come up with some unique, approaches that are going to really resonate with our consumer based off of what we know they do and don't like about our products. And we want to lean into the whole concept of, I don't know, of something, ghost related, and come up with 10 ideas. And ChatGPT will help you come up with 10 ideas with the context of all the reviews it just finished reviewing. And it's a starting place for your, marketing team to then say, hey, we just came up with 10 concepts that we probably would have had to pay a, branding agency probably 30 grand to do for us previously in a really short amount of time. So like, that's really exciting. What it's not going to do today is create all the assets for you, help you deploy those into market, collect the feedback on what's actually working well or not working well within, market. All those other components of really running and operating the marketing team. 2 to 3 years from now, 4 to 5 years from now, you'll be able to click a button and have that asset generated for you in seconds. And I'm not even just talking about images. It's going to be video too. And that's going to be a game changer. And I think it's even going to get to the point where you're going to see Meta and Google and the other big, platforms that have the budget that do it. You're never going to have to leave the platform to develop an entire campaign. You're going to say, hey, I want to create a campaign for my dog food company for October, where, all the dogs have, little ghost costumes on, and they're going door to door trick or treating. And you click a button and you're going to have a video of that made for you. And then Meta and Google and all these other things will be able to natively regenerate and A/B test your video assets for you. Like, I don't know for 5 years or 10 years away from that, but like that is coming in our world very soon. And that has some really massive implications for how you think about the type of talent you need on your team today and how your talent is going to evolve over that next 5 to 10 year journey.
Makes sense.
So Matt, you mentioned something earlier, just holding on to from the conversation. It was a great example of saying like, a little bit of luck was, some organic influencer just came and tilted the scales in your favor for a while, and that's going to wear off. And I know you work reviewing and looking at and considering the paid influencer programs for people. And I remember you saying to me one time in passing, like, and not too surprising, right? But like that sometimes you'll have a couple of outliers and performance wise that can really, I mean, this happens in all media plans, right? But specifically inside of influencer, a couple of them are kind of subsidizing the dogs and make the channel look okay. But how, since you've looked at this kind of data, I was just kind of curious just how lopsided you've seen it, and is there anything you can share for people to look out for when they're interrogating their own influencer programs?
Yeah, I think most people do influencers wrong. I think like terribly wrong. I think most folks, when they build an influencer program, they go, let me go find the influencers that look like what I want my aspirational customer to be. Okay. So, if I'm a, tech company, let me go find the, 27-year-old, female, physics award-winning scientist who, just came back from a trip to, I don't know, some big science exhibit in Europe and just wrote some big paper, and like this person's going to be the face of our campaign because she's techie and she's cool and she's edgy, and like that's going to be it. But if her audience is not your target demographic, it doesn't matter if her as a persona is who you want to embody, her audience is never going to buy your product.
Right.
So what I often say is, to increase the likelihood of having success in an influencer program, don't just go get the influencers that you think look like who you want your aspirational audience to be. I'll give you another example. I always find fitness companies tend to go out and get like the athletes and, the marathon runners and those type of folks. But often the people who are buying their products are like middle-aged parents in middle America, and they're not watching the 22-year-old, Paralympic, athlete who just won a gold medal. They're watching like baking channels and makeup tutorials and like those type of things, right? Or like how to build your home garage or like things like that, right? And go find those influencers that actually speak to your target demographic. You're going to get a much higher hit rate on, the successfuls compared to the failures than if you just go after the ones that are flashy and aspirational.
That's awesome,
Yeah.
man. That's the first time I've heard that. So thank you for sharing that with us. So everyone, very lucky.
Well, let's keep talking measurement. I'll take us like closer and closer, our comfort zone. What's one of the metrics you calculate to compare influencers? Is there?
Yeah, I mean, I think it's really just what I was just going through there, right? Which is it's impossible to really know exactly every dollar that any influencer generates. You can give them links, you can give them codes, you can do all these different things to try to track them. But at the end of the day, it's somewhat of a brand investment. And you're going to try your best to judge the return based off of those codes or custom links or surveys or whatever else you're doing for attribution on that. But at the end of the day, as I think about what makes a successful ad, regardless of whether it's an influencer or a paid ad or whatever it might be, it's getting the right message to the right consumer at the right cost.
Yeah.
So as we think through that, if you can find the right influencer with the right target demographic and you can craft the right message to hit that demographic, then really what I care about is how much did it cost me to reach that target demographic is kind of the last factor. So what I tend to look at is what was my CPM, not on their followership, not on their total number of reach that they get, but on what percentage of their audience falls within my target demographic. And if I can optimize towards that type of CPM across my influencer program, I'm going to have a higher chance of being successful, even if I can't measure every single dollar that comes back from that program.
I know this is going to be your sample size, but I've seen influencer programs that get kind of conflated with discounts. So they're going to provide a discount code if you use it. And so what you're learning is this is the increase in response rate by getting this influencer's ad in front of people. But you could have a whole bunch of people that were already part of your brand that are like, yeah, but I'm going to use this code to get the discount, and you kind of overcount. Have you seen those? I mean, those two variables kind of cross paths before, or is that just something that we've seen in our?
No, I mean, that happens all the time, right? And it's a really difficult balance in influencer marketing because the influencer wants to be able to give something unique to their followers, right? And as a brand, you want to incentivize those folks to buy from that influencer because they feel like they're getting something unique from that influencer. At the same time, if you're going to have a program with 200 influencers in it, you really don't want to have 200 different influencer discount codes out there. So it's a really difficult, balance of like, how do I provide the right incentives to the influencers' audiences while also maintaining kind of margins and a sustainable program that doesn't have 250 discount codes floating around in the ecosystem at any given time. So I still like to use those discount codes. I tend to say like make it marginally better than whatever your standard discount that you offer on your website is. If you have like a $20 welcome offer, maybe you make it 25 for the influencer and that's just kind of go-to, but like, so it still is better than what they can get from coming direct. But at the same time, it's not, hopefully not meaningfully changing your margin profile as a business.
Right. I like your advice there because sometimes I've seen this with influencers or even traditional affiliate programs. It's a marketing channel, but for some brands, it's a discount in disguise. They're like, we're a full price brand unless you go to this affiliate, or like we're a full price brand unless you come in for this influencer, and they're having a hard time. In other words, this is the investment level if you're willing to take the margin hit and kind of migrate some of your other demand underneath this channel. And that's like a pretty dynamic system for people to get their hands around.
Yeah. And scaling up influencers is unfortunately not like scaling up Meta, right? Like if I want to double my budget on Meta, I click on a little button and I type in a 2 instead of a 1, and I've doubled my budget on Meta. If I want to double my number of influencers, I need to double my amount of outreach, double the amount of creative I'm reviewing. So it's a hard program to scale and do successfully.
I mean, it's pretty amazing how effective Meta is at letting you double your budget. They've made a very intuitive interface for doing that.
Oh yes, all the ad platforms have gotten very good at just giving the controls over to the platforms.
So we're always, standing there and saying, I hinted at it before, like whatever the play is on the field, whatever quality of influencers or in your case, whatever quality of finding influencers that speak to your audience that you've gotten, we're coming along and saying, load your data in the LiftLab and you can kind of uncover what your own performance, instead of an industry benchmark, what your own performance is. We do a lot of that through building mixed models. I thought I'd kind of take us over in that direction. I sometimes have talk tracks around, me watching mixed models get presented, but you've probably seen as many or more than I have. I'm just kind of curious. Have you ever seen like a brand that, I don't know, rejected the organ transplant, like, we just weren't ready to receive that kind of information or had a lot of scrutiny of it. Like, I mean, it comes in all shapes and sizes. I was just curious, any anecdotes you could share?
Yeah. I think media mix model is just a raw media mix model by itself in isolation is no more accurate than a person sitting there in Excel and trying to figure out how can I put the right budget in the right place. And I think that's ultimately because at the end of the day, it's just a correlation, right? That you're trying to find which random blend, if I create 10,000 random blends of my media spend, which one is most correlated to the business output? And correlation will never be causation. And I've seen some really weird outputs from media mix models because of that. I've seen outputs that have said, hey, 10x your spend on this channel, it's going to be your most profitable. And I look at that and go, I have a hard time believing that. And you go back and you run a incrementality test on that channel and you find out, actually, not only should we not 10x it, we need to cut it in half. Right. So it's without guidance, I think media mix models can actually be more dangerous than helpful, which is why I think like a solution where you can combine both incrementality testing with media mix modeling allows you to get to a place where you are removing the risk factors associated with correlation on testable channels, and you're only confining the risk of over correlation to just the channels that can't be tested, like influencers or something, right, where you can't do some sort of geo experimentation around it. So that's just where I just see the industry continuing to go in that direction. And I'm starting to hear it more and more now. If I go back 2-3 years ago when I was interviewing CMOs and heads of growth and other folks, and I asked, what's your approach to measurement? You didn't hear a lot of incrementality testing. Now it's coming up in every conversation. So it's exciting to kind of see that transition. But at the same time, there's a ton of companies out there that are still using kind of raw out of the box media mix models. And I've seen the results all over the place, depending on who's turning the keys behind the model.
You mentioned about the accuracy of the models or the fuzziness of the correlations. There's also the other side that we talked about of the market mix models being the scapegoat of an organization. If there's problems, it's your media mix. Could you tell me a little bit about navigating, removing it as a scapegoat and being like a starting place versus a finishing place?
My entire career, whether it's been, coming into a portfolio company, interviewing for a new job, whatever it may have been in the past, I'd say from the day I graduated to today, the thing that's always been consistent is, hey, we're looking to hire a head of growth to come into our company. We need a media ninja to come in and fix our media mix. And I'll come into that business and look at their media mix and I go, yeah, okay, fine. Maybe we could be optimizing this a little bit. Maybe we're not using the ideal bid strategy on Meta. But your product has a 2.7 out of 5 in the reviews that we're getting in. Your website looks like it was made in 2007. You're just doing statics. You don't have no video assets and you're running, $10,000 a day on Meta. Your social channels are woefully underdeveloped and you aren't engaging with your customers in a meaningful way. All these other things are wrong about your business and your marketing approach. I don't want to touch the media mix right now. And it's more often than not that people go, well, Yeah, I get that all that is broken, but that's going to take a lot of time and money to fix all of that. But you can change the media mix today. So like, let me know how to make the media mix better. And it's kind of just like, yeah, okay, fine. We can optimize for the bottom 5% of opportunity here, but we're leaving 95% of the opportunity on the table. So I do think media mix is a really easy thing to scapegoat. And I think that's just because it's what's your most controllable in the short term. And it's also the easiest for CEO to understand as, where can we potentially find a quick win?
Yeah. Well, it's funny. That reminds me of a story when I was at Snap. One of my clients changed their app and you physically couldn't purchase anything on the app anymore. And they were like, Snapchat ads are not working at all. We get zero return. And then I went through the process, tried to make a purchase and couldn't. And I think it's seeing what the customer sees and trying to understand that is definitely the diagnostics that happen before the heavy data. Because to your point, if you can't purchase on an app, it doesn't matter where you allocate your money.
100%. I think what you actually just said there is going back to the conversation of like a good marketer versus a great marketer. Good marketers know how to optimize their marketing strategy to what's going to be best for the business. Great marketers know how to optimize their marketing strategy for what's going to be best to the customer. And it's a really, really fine line, but a really important nuance that I've seen companies get tripped up on, right? Where they go, hey, we aren't, going to use humor on our TikTok page because that's not brand aligned. Meanwhile, when they do put up something that is somewhat humorous because they finally cave in and want to try it, they get 10 times as many views as they've ever gotten on TikTok before. Why? Because that's what the consumer wants to see out of that brand on their TikTok channel. And it's a really fine line between how do you maintain your brand and build your brand in a way that feels authentic to the company and allows you to build your positioning, and how do you show up in the way that the consumer wants you to show up. And the best marketers out there really look at everything from a consumer first perspective versus a brand first perspective. And it doesn't necessarily mean that you can't be a strong brand marketer while still being consumer first.
Yep. And I think engaging with the consumer, right, with their content and what they respond to is making that dynamic piece. And it's harder to solve for than just pushing messages on people. But if it's resonating and people are recreating your content or doing additional things with it, you should want to facilitate that to happen. And by the way, that was like the perfect clip of good and great marketers. We're definitely going to use that in post. That was awesome. But I do want to make sure that we have a little bit of time for any Q&A, any questions for people in the audience here. I mean, we could keep rolling. This is an awesome conversation, but I do want to make sure that anyone of the participants that came in here, if they wanted to ask LCAT Matt any burning questions, wanted to make sure we address those.
Yeah, that's a good call to action. Get it into the chat or into the Q&A section of the Zoom. While folks are typing out, if they have a thought or two, I had a question. This can be a little open-ended, Matt, so you can go where you want with it. But and you kind of hinted at this before, like some people, mix is not the biggest priority, right? So when they get there, when they've kind of done a lot of the block and tackle and they've got the kind of a healthier, execution, healthier strategy, some of their, I like to tell people, you should at least be in love with the ad platform numbers, right? I mean, if you don't love those, it's probably something that you need to fix. I kind of wanted to have an open question here around the soft skills of how do you get a team to kind of pick up a different set of metrics, or maybe you could put this collectively under, are there any good or bad, either end of the spectrum, around change management that you've seen people kind of demonstrate? It could be something like you just say, don't ever repeat that, or it could be something that, as a best in class. But I know it's open-ended, but change management's often overlooked. We sometimes think we're going to get new metrics and then everything's going to work magically. And there's a pretty big gap there between, the shiny
new. It doesn't happen
object
overnight, right? And
yeah.
I've seen this time and time again, where, I will run a bunch of geotests. We get all these incrementality measurements. We start to optimize the media mix. And then I have, my, quarterly connect with, the, finance org to do projections for the rest of the year. And they go, okay, yeah, but what was the last click, CPA for Meta? And I'm like, no, where we are not using that anymore. And, I, what I like to use in change management is data to explain data, right? So I could just go to the finance org and say, hey, no, we're not looking at that anymore. We're using this new incrementality metric. The CFO is going to go like, oh, okay, well, I don't know what that is. And I've never used that in a P&L before. That's really foreign. I have no clue how to build that in. Mm-hmm. So what do I do instead? I will go and show, hey, look, if we were to use those last click metrics that you're using in your P&L today, here's how we would have optimized our media spend. It would have looked like this. Based off of the new analysis that we have done, if we had done the media mix like that, we would have generated X number of dollars in the last quarter and X amount of profit. Using this newer approach, our media mix looks like this, and we're going to generate X amount of dollars in revenue and X amount of dollars in profit. And, I'm relatively comfortable in Excel and P&Ls myself. So I'll actually sometimes go in and say, hey, let me show you how you could build this type of incrementality measurement into your P&L and replace what you're using today in terms of your older, last click approach in that P&L, and make it really easy for them to transition into something new and have them be fully bought in on it. You never want to put your finance team in a place where they need to figure out how to build incrementality measurement into a, financial P&L, because that's just not the language they speak. Right. So sometimes it's just about rolling up your sleeves and, getting into the finance world with the finance team from a marketing perspective.
I have to say that was the most seamless working in of a question. Peter, thank you for that question. It was so seamless. It wasn't formally asked. So that was awesome.
Maybe we wrap up with a little bit more on change management. Hopefully this isn't too ending on a stating the obvious, but Matt, have you ever seen folks that still had the wrong incentives? Like, were there ever incentives that blocked the rollout of better measurement? I don't know, like a bonus tied to a last click number. I don't know, or maybe that's too easy. Maybe there's other ones more obscure that I haven't seen, but I'm just kind of curious.
I don't know if there's necessarily incentives that are driving. Sorry. There definitely are incentives sometimes that organizations have that drive towards the wrong decisions, but I think they're typically more complex than I'm incentivized based off of last click attribution. So I don't think I've seen much of that in recent times. But there definitely are incentives that are sometimes wrong, right? Like maybe it's not necessarily last click attribution, but they're tied to, a certain, maybe a finance team says, hey, you're not allowed to spend more than, 12% of the e-commerce revenue on marketing. Maybe the right answer is to spend 15%, right? And, unless you have the, green light to go and test with, market tests on, maybe half the country you hold at 12%, the other half you go to 15%, and you see whether or not you could prove net incremental, revenue and ultimately profitability on that increased expenditure. If you don't have, the authority to go do that, then it's really hard to optimize your spend in a way that's meaningful. And ultimately that just really comes back to just old ways of thinking sometimes. And like, to the question that Peter was asking about, like, how do you get your financial work on board? Like your CFO might be super nervous about going to 15% of spend if the company's never done that before. And, that's where you're just going to have to kind of put your foot down as, the head of marketing, CMO, head of media, whatever your title is, and say, well, I have a lot of data points that indicate that we are underspent today and we have to go take a risk to go be successful. And if we're not comfortable taking that risk, that's okay. But I want to outline the downside of not taking that risk, right? Here's what we could potentially be leaving on the table. And I think it's that type of conversation that just has to take place. Otherwise, these kind of artificial guardrails that companies put, on their marketing teams really put you into a corner that's really hard to work your way out of if things start going, in a not so great direction.
Well, I mean, for me, this is maybe our mantra, but we're teaching teams to think about communicating to finance the trade-offs of growth and profitability. And because anytime I spend on paid media, unless I do something very convoluted, I'm going to make revenue go up, right? That's fortunately for marketers, we have a one-way bet, right? I mean, you have to try pretty hard to spend more and make revenue go down. I mean,
you'd have to do something pretty crazy with your creative to make that happen.
Well, I mean, Peloton pulled it off for a short while, but again, you have to really make an effort. But you may or may not be doing that profitably. Or if you flip that on the other end, it may be that you want to give up some profitability in order to achieve a certain target growth. So I found that being able to see brands come in with we sometimes call it an adult conversation, right? About, okay, yes, I can hit that growth number if you want me to, but I'm going to do this to profitability, or the other way around. I can hit that efficiency, but we're going to slow down. That seems to be, it seems like marketing showing up with owning a dialogue that finance has been craving.
Yeah, totally.
And I do like when you said it's the cost of not doing something, since finance normally operates in it costs me to do this, it costs me to do that, it costs me to do that. And you're providing it costs you this to not do that, which I think is a unique argument that resonates financially. So yeah, I think that's great. We have one final question and then we could wrap. This would be, do you have, this from Jennifer, do you have a favorite brand or one that you think is killing it right now?
No, I don't. And that's because
you have no favorites.
I love the honest answer.
No, I don't have any favorites. And there's an important reason for that, which is because whatever brand I like and I think is doing a great job, that's because they're resonating with me personally. It doesn't mean that they're necessarily in a perfectly optimized place from a marketing standpoint. And as a marketer, that's what I care most about. And it's impossible to know without actually having the data and the insights into everything else we've been talking about through this entire conversation to know whether or not a company is really killing it or not in terms of the effectiveness of their marketing. The number of times I've looked at orgs and said, wow, they're doing a lot right. And then I get into that org and I go, wow, they're doing everything wrong. It is a surprising high percentage of the time. The number of times where I'm like, wow, that company's marketing is kind of bland. And then I get into that org and I'm like, wow, but they actually are building something really cool and their product's just absolutely amazing. And the marketing's going to get there. It's just not there yet. Like that happens just as frequently. So I would say what really makes a brand kill it is great product at the end of the day. Marketing is completely irrelevant. If your product is terrible, you'll be able to sell that product in the short term, but eventually people will realize the product's not great and they're going to go away. So I'd say the brands that are killing it are the brands that really make great product that consumers love. And then marketing is just giving them the reason to buy it.
Awesome. I think that's a great note to end on. Matt, thank you so much for coming. We had an awesome discussion. And for our 8th installment of Curve Your Enthusiasm on August 27th at 2 p.m. Eastern, we're going to have Jim Warner. He's the Global Field CTO of Advertising and Marketing at Snowflake. So Matt, again, thanks for coming. Everyone who showed up in the chat asking the questions, thank you so much. And we'll see you guys on LinkedIn, in client meetings, and maybe just hanging out at a Mets game.
All right.
All right. Have a good one. Thank you. Bye.